Welcome again, and let's see the next part of the video. So, pre and post acquisition profit. So, what's the pre acquisition profit? As we know, it's very simple. Pre acquisition. So, before acquisition, if there is any profit, that should be adjusted. So, the profit actually made before the date in which the parent acquired the control. This is pre acquisition profit, and it represents the net asset acquired net assets at acquisition date. It is being represented by the asset what is acquired, and as we saw it before, it is actually being dealt with the goodwill calculation. For example, how much you paid for acquiring a part of the subsidiary, and how much you are what percentage of the capital you are acquiring. So if you pay more, that is being recognized as goodwill. So this is what we already know. And what about post acquisition profit? This is a kind of new for us. So the profit that actually made after acquisition, and this is actually included in the consolidated income statement. This figure comes from consolidated income statement of the group. And intercompany balances. So if there is any balances of the subsidiary to the parent, or parent to the subsidiary. So these are the intercompany balances, like preferred share held by the parent. So some of the preferred share may be owned by the parent company. Some of the bonds of the subsidiary can be held by the parent company, and intercompany trading and loan balances maybe. So one company provided loan to other, it can happen. So if the parent can give loan to the subsidiary, and subsidiary can give loan to the parent as well. And intercompany dividends payable, or interest payable, or receivable can be on the loan amount, also can be there. So these are the intercompany balances. And the other thing is, so what about the preferred share held by the parent? So preferred share acquired on the date of acquisition is being represented by actually the assets of the acquisition date, and the same way it is being dealt with the goodwill if it is acquired on the date of acquisition. And the part that is not acquired is obviously is non-controlling interest, as we know before. And in case of bond acquired on the date of acquisition, is the same thing as that is being represented in the assets acquisition on the date of acquisition, and dealt with as before with goodwill. And the amount bond acquired on the date of acquisition is appeared in the balance sheet as long as a long-term loan in the financial position state. In case of intercompany trading and loan balances, what we have to do is it actually should be it should be reconciled with the statements of the subsidiary and the parents, and usually the figures should be the same, right? So parents invested in the subsidiary, so parent will show the say £5,000 as investment, and the 5,000 figure would be recognized by the subsidiary as loan. So the amount is same. But there may be some differences because of the timing differences, such as cash in transit, or so what we have to do is we need to consider and update balances to make it equal. And and we have to actually, as the figures are same, and these are the figures that we need to eliminate from the group accounts. Intercompany balances are supposed to be eliminated from. So subsidiary can recognize as debtor in the parent parent balance sheet, and the parent as creditor in the subsidiary's balance sheet. So this is a kind of a opposite transactions, or the amount is being recognized by two different balance sheets of the parent and the subsidiary. So this is in case of the group, we will eliminate that from the group accounts. So let's see the example. Pros acquired in verse. So 80% of the shares of 10,000 shares of one parent common shares for 21,100, and 20% of the preferred shares for 2,000, and 10% of the bonds for 900. And the retained earnings on the first day, all these are the first day of the year. Um, Retained earnings balance at the beginning 4,000, and the non-current assets is actually the fair value is actually 1,000 higher than the book value. And during the year, there are some transactions happen between the organizations, like the pros sold inventory to Verse for 3,000. All right, and in these figures, 25% is actually profit. Yeah, and half of these inventories are still unsold in the books of the subsidiary. So there are some profits actually unrealized. Parent company shows us profit, but the profit is still not earned by the parent or by the subsidiary, because the subsidiary couldn't sell actually the half of the inventory. And yeah, group accounting policy. So we will discuss this. It should be uniform group accounting policy. So the group, the parent and the subsidiary should actually recognize or apply the same accounting policy in case of preparing their books of accounts. So in this case, it says the increase non-current asset by 100% of excess. So as we recognize that the non-current assets value increased by 1,000, so 100% of the increase should be recognized in the books of account. This is the policy of the group of accounts, group of companies. So these are the assets, asset side of the individual company and also and the group as a whole. So as we did before, we have to recognize, we have to find out firstly the goodwill amounts, and yeah, and the non-current asset. As we can see, there are some this 1,000, the value increase is adjusted here. So the total of the parent and the subsidiary plus the adjustments, like the increase, is recognized here. And investment in the subsidiary is 22,000. This is what they invested by parent. Yeah, and how this came up, we have to calculate this based on the acquisition of the parent on the subsidiary. The inventory, as we see, there are some unrealized profit that need to be adjusted, as we mentioned before. So yeah, this is what we need to adjust. We have to find out how much profit is still unrealized, and that need to be deducted from here. And the Verse current account in the books of the parent, right? This is the subsidiary's name. So Verse is subsidiary. Subsidiary is current account in the parent account, and this is the intercompany balance, as we mentioned just a few minutes before. So, and the same amount is recognized by the Verse in their financial statement as liability. So this is the asset in the books of the parent, and we can see it the same amount. Pros current account is in the Verse books, 8,000 is the same amount as recognized by asset by the parent and liability by the subsidiary. So this is the intercompany balances, as we mentioned before, just a few minutes before, that this 8,000 is actually should be omitted from the group account. So we are not recognizing that amount, 8,000 in the books of the group. This is actually cancelled or adjusted or omitted from the group accounts. Yeah, and also dividend or interest receivable or payable also need to be need to be omitted, because one company is showing interest receivable, so parent is showing 35 on interest receivable, and at the same time subsidiary is showing interest payable. Right, so the total interest payable, and out of this 35 is for the parent, so we need to omit this figure, and the remaining interest is to someone else. So the remaining interest should be recognized in the books of accounts, not the interest amount due to the parent. All right, so this is how we need to adjust our accounts. And in case of liabilities, yeah, as we know, we should consider the parent figure for the group. Retained earnings, so we need to adjust the considering the earnings during the period. So this is what we need to add with the pros, how much has been increased in the parent account. And non-controlling interest is 6,100 that we need to calculate based on the percentage. Yeah, and loan amount also need to be omitted from the subsidiaries account, because this is also intercompany transaction between the group, between the parents and the subsidiary. So 700 actually the loan provided by the parent to the subsidiary. So this 700 we need to omit from the loan of the subsidiary. So if you add these two, it's actually 5,000 plus 7,000 is 12,000, minus 700 is actually 11,300. And as I mentioned before, this need to be omitted from, because this is intercompany transaction, need to be omitted, and this 35 need to be omitted as well. Yeah, and these two just add together, and this is what is the group financial statements. It's very simple if we understood. Yeah, and let's see the details here. So how can we calculate the goodwill figure for the parent company, as we did before? So how much is the investment? Is 22,000, and how much they acquired? 80%. So 80% of the shares of the subsidiary, you can see shares of the subsidiary, and the retained earnings of the subsidiary is mentioned here, 4,000 in the beginning. So all these and need to be considered. Yeah. So the share capital 21,000, 80% is acquired. Retained earnings on the beginning day 4,000, 80% is acquired. And fair value increase 1,000, so 80% is for the parents. This and loan 7,000 of the subsidiary that is being acquired by 10% is of the parents, so this is 700. So altogether 21,500. So their investment is 22,000. So remaining 500 they are paying as goodwill, and this is what we have calculated. So 21,500 they acquired, and their investment is 22,000. So 500 is goodwill, and this is the first stage that we have recognized. And let's see now. So the intercompany transactions need to be set off. So as we mentioned before, so 8,000 is the balance shown in two different balance sheets. So parent company shows 8,000 as asset, and subsidiary company shows 8,000 as liability. So both accounts shows in the opposite side, and we should not recognize anything in our books of accounts for 8,000. And interest amount or due 700, I think, 350. Yeah, and out of this 350, 10% is the interest receivable by the parent, that is 35 pound. All right, and so this 35 pound is recognizing parent as receivable, and 35 is recognizing by the subsidiary as payable. So this is also intercompany transaction, and this is also need to be omitted from the group accounts. So, and what about the remaining 90% is invested by someone else, other party, right? Outsiders. This is actually would be recognized in the books of accounts of subsidiary and also in the group accounts. This is what we show here Yes, interest total was actually 350, and out of this 35 was due to the parent. So the parent amount was reduced, deducted, and remaining 315 actually recognized in the books of the groups. And similarly the loan account as well. So total loan actually 7,000, and out of 7,000, 10% is the loan that is provided by the parent. That means 7,000 times 10% is 700. So this 700 need to be deducted from the loan account, from both accounts. So this is what we should not recognize in the books of of the parent or of the subsidiaries. So the 700 is actually deducted from here. So the remaining figure is recognized. So the intercompany transactions are omitted from the books of accounts. And as we mentioned before, intercompany transactions like parent company sold 3,000 inventory to the subsidiary, and out of this actually 25% added as profit. All right, so 25% added as profit means what? Profit on cost 25%, and what is the profit on sales price is 20%. Yeah, on cost 25%, and the same amount of profit if you calculate based on the sales price is actually 20%. So 600 profit has been added. All right, so there are different ways you can calculate this 20%, or you can use 25%. You can calculate like so. If you think the cost is 100, 25% profit on cost means what? Cost is 100, profit is 25. So what is total? Sales price is 125. So 125. If the sales price is 125, and what is the sales price now? Is 3,000. So 3,000 divided by 125, then you will get 2,400 as the cost figure. All right. So if the cost is 2,400 and the sales price is 3,000, so how much is the profit you added? So 3,000 minus 2,400, that means 600 you added as profit. This is another way you can calculate as well. So, and half of the inventory still is remain in the books of the subsidiary. That means half of the profit is unrealized. That is supposed to be deducted, right? If the profit is earned, if all the goods sold out by the subsidiary that has been purchased from parent, if the whatever purchase all sold out, if this was the case, then we don't need to adjust anything. But as some of the products still remaining, so the profit recognized by the parent in the books of accounts, that is half of the profit, is actually unearned, is not earned yet. So this is what we need to adjust. We need to deduct from our books of accounts. So this is what we actually deducted from here. Yes, inventory 300 we deducted. All right. And finally the liability side. So we have to calculate what is the total capital and and also the retained earnings of the parent and subsidiary should be recognized in the group accounts. Yeah, so the share capital, as we know, we have to recognize only the parent part. So parent company's capital is 24,000, and preferred shares only parent part is 4,000. And the retained earnings parent part was 30,000, but 300 unrealized. So we have to deduct this one. So 29,700. But there are some post-acquisition profit, the retained earnings after, that means at the end of the period, right? After acquiring some profit during the period, retained earnings recognized in the books of the subsidiary is actually 8,500. Right, but previously how much it was? It was 4,000. So how much increased? So on the increased figure, so parent will get 80%, right? So on the 8,500, 80% is of the parent, so 6,800. But already we recognize 3,200 on the first day of the accounting period. So we have to deduct this one. This is already recognized as the parent figure. So the remaining 3,600 now we need to add with the retained earnings of the parent, right? So this is the retained earnings balance of 33,300. So yes, so this is 33,300 of the parent's retained earnings now, right? And this is what the capital that we calculated here, 21, what is called 20 parent figure, yeah, so 24, and then shares 4,000, yeah, 24,000 is the capital of the parent. Yeah, this one, and this one is the retained earnings. Yeah. Mm. And yeah, and that's all about preparation of the consolidated financial statement after the acquisition, after making some transaction between the organization. And if we have any question, we can discuss in our seminar. So as I mentioned before, the uniform accounting policy should be applied by the parent and also by the subsidiaries. And accounts with year ends within 3 months of each other. So within 3 months after, at the end of the accounting period, they need to adjust significant transactions between the organizations and need to prepare the consolidated financial statement within 3 months of the end of the period. Yeah, and there are some review questions, conceptual review question, and practical review question that we will discuss in our seminar. So go through and yeah, and try to understand the concepts and the problems that we discussed. And if not, and if you have any question, I'm happy to help you and discuss further in our seminar. Thank you very much for watching.